Good afternoon, everyone. Welcome back to Protect Your Farm Business, where we talk about agribusiness related topics. I am Ashley Westerhold, and I work for the University of Idaho Extension. So today we're going to be discussing understanding your financial situation. And so I just wanted to say, if you need help with this, you can see in the description box that the University of Idaho has a program where we are able to actually help you generate this financial measurements and really understand your financial situation better. But if you're really good at doing the books at home and you have all these numbers already and don't need us to help you, I just wanted to give you guys some tips and look at some ratios that might help you determine how well you're doing. So with that, I'll start out with the PowerPoint for today. And so we'll be talking about financial measurements. So the reliability of a financial measure can be enhanced by an understanding of the accounting method used and the accuracy of the financial information, the type of enterprise and the degree of integration and diversification, strategic adjustments and major changes in management, the point in the business life cycle, and the size of the operation. So I think one that's really important is the point of the business life cycle. So depending on where you are, your financial situation can be a lot different. And if you are in, I'll get to it, if you are in a lower ratio or not where you think you should be, but you have just started, then you shouldn't worry as much as if you were already established. So we're going to go through a couple of ratios in ratio analysis. And so I just wanted to state the measure in the ratio, show you how to calculate it at home. And then we have assigned green, yellow, and red, just kind of like the stoplight that you see with the picture. And that's just to signal, are you in the caution area? Are you okay? Or are you in the go? You're doing very well with the green. So explains its purpose and characteristics. So we will be looking at different financial measures. And the first one of these financial ratios really dive into this idea of liquidity. And so liquidity is a short-term concept. It measures the ability to meet financial obligations as they come due without disrupting normal production. So it's the ability to generate cash. So today, if you had something that came due today, how much liquidity do you have? Can you pay those debts as they come due? And that should show you your liquidity. Well, what does that look like on your balance statement? So the ratios that we use for liquidity, the first one is the current ratio, where it shows the current assets compared to the current liabilities. So you have the total current farm assets divided by the total current farm liabilities. And so a strong ratio would look something like 1.7 or greater. Caution is 1.7 to 1.1. And then you're in the vulnerable state if you have less than 1.1. And so your current liabilities are very close to the amount of current debt you have. So therefore you might not be able to pay something as it comes due, which could be scary. So greater than 1 is the safety margin. You are more liquid if you are greater than 1. A second liquidity ratio would be working capital. And that's the money left over after selling all current assets and paying off all current liabilities. So total current farm assets minus total current farm liabilities. And if you have a strong working capital ratio, then you have a large positive. So you have lots of money left over after you pay off your current debts from your current assets. So caution would be small positive, and then vulnerable is negative. If your debt outweighs your assets, then you will be in a vulnerable position. So safety margin is a dollar value. So if you have more than 0, compared to similar operations and past trends. It's really hard about working capital. You can't look at your neighbors if they have a different operation and say, what's your working capital? Everyone's working capital will look different, and it depends on the size of your operation. So, solvency. So solvency is the degree to which liabilities are backed up by assets. Liabilities versus owner equity. Ability to pay off all liabilities if all assets were sold. So the first ratio would be the debt to asset ratio. And that's the proportions of total assets owed to creditors. It is total farm liabilities divided by total farm assets. And so if you have a strong debt to asset ratio, it should be less than 30%. And so it's saying that if you were to sell all of your assets, you only owed about less than 30% of those assets to the bank. So that's a really good ratio. Caution, 30 to 60%. So that's saying that your debt is about 30 to 60% of your assets, which could be kind of scary. And then vulnerable is greater than 60%. So maybe the bank owns the whole farm. And so you would have a vulnerable greater than 60% debt to asset ratio. Which again, it depends on where you are in the business cycle. This might not be as scary as if you're just starting out, but it could be a very big point of caution if you are later in the business cycle. So lower values are better. So then we have the equity to asset ratio. So it's the proportion of total assets financed by equity capital. And it's total farm equity divided by total farm assets. So a great ratio would be greater than 70%. Caution is 70 to 40%. Vulnerable is less than 40%. So less than 40% of your assets are actually owned by you in the equity that you've put inside of them. So higher values are better. Solvency. Again, another ratio, debt to equity ratio, in the lender financing compared to owner financing. So it's total farm liabilities divided by total farm equity. So it's strong, less than 43%, caution, 43 to 150%, vulnerable, greater than 150%. Lower values are better. And this can also be called the leverage ratio. So the third one we will be talking about today, and I think it'll be our last one for today, and then I'm going to do a part 2, is profitability. So profitability measures efficiency in using resources to produce profit, and profitability is measured according to the goals of the manager. And so one of the ratios is the rate of return on assets. So what is the rate of return on equity and borrowed capital? So stronger than 8%, caution 8% to 4%, and vulnerable less than 4%. So it depends on the cost. You need to check trends within the business. And then you have the cost value and market value. And the market value compared to similar operations, other investments, opportunity cost of capital, and past rates. So you might think a return on assets as, what will I make on this land however many years from now? And that would be your rate of return. Same with different capital. So what is your rate of return buying new equipment? Does the new efficiency benefit you by buying that new piece of machinery? So it depends on your interest rate on borrowed capital and your opportunity cost of your owner's capital. And so the opportunity cost is what else could you have used that money for? And maybe that is playing in the stock market or doing something different where you could have a higher return. But it's really up to you. So rate of return on equity, it's the return on owner's share of capital invested. So strong is greater than 10%, caution 10% to 3%, and vulnerable less than 3%. So the cost value, checking trends within the business, market value compared to similar operations, other investments, opportunity cost of capital, past rates, depends on opportunity cost of owner's capital. Warning, it is artificially inflated by low equity. So just because your market value on an asset is showing a lot doesn't mean you've actually put in that amount of equity into that property. So operating profit margin. Operating profit as a percent of total revenue. So strong, greater than 25%, caution, 25 to 15%, vulnerable, less than 15%. Again, the cost and market. Higher values mean more profit per dollar of revenue. So per dollar of revenue, you are able to get more profit because that operating profit margin. So what is your net farm income? Well, it's the income available for owner withdrawals, income taxes, and equity growth. There's cash income minus cash expense divided by inventory change minus depreciation. So a strong ratio would be a large positive, caution, small positive, vulnerable, negative. So the goal for net farm income is that income that owner's labor, management, and capital could earn in non-farm uses. So if you are able to make as a net farm income the same as if you had an in-town job, that's a really great goal. And I know a lot of people rely on their accountants to maybe show that they didn't have any net farm income, but it is good to pay taxes sometimes, and it's great if you want to have Social Security benefits. So just think about that in the future. When you have good years, don't just go buy equipment if you don't need it. So compared to similar operations and past trends. And so those are the top, I would say there's three different, the first three financial measures: liquidity, solvency, profitability. And next week, we'll be talking about repayment capacity and financial efficiency. And so I put in the description box actually a couple of really cool supporting documents that we get a lot of information from. One is the University of Minnesota Center for Farm Financial Management, and they show you where you can fill in a worksheet that actually can help your operation, and you can print it off at home. And then the same with the University of Wisconsin. It's a little different. But again, if you're interested in wanting our help in creating these ratios, or looking at your financials, please reach out to us. I also put a link in the description on how to be a part of that farm benchmarking program that Idaho is doing. And that way we can help you with your financials and give you these ratios for you to know and continue to keep up with you each year. So with that, if there's any questions, I can wait for just a few seconds. But next week, again, I'll be talking about repayment capacity and financial efficiency. And so I just want to thank you all again for tuning in and watching these videos. I hope you get something out of it, and I will see you next week.